Covered calls are a tool that can be used to create short-term income in a stock position. In this video, we're going to cover how to construct a covered call, the risks associated with covered calls, and why you may or may not want to consider covered calls as an income strategy. Covered calls are designed to create income on a stock position. There are many different approaches to covered calls. In this video, we're going to discuss a traditional growth and income oriented approach. To build a covered call trade, you must first own the stock. You can do this trade with stock you already own, or you could buy the stock as part of the initial trade. When purchasing the stock, you should make sure that you own the stock for the correct reason. In other words, you should have an overall outlook on the stock that is neutral to moderately bullish. Since a standard option contract represents 100 shares of stock, you need to own at least 100 shares of stock in order to place a covered call trade. The second step in a covered call trade is to sell a call against the stock that you own. Remember that when you sell a call, you're agreeing to sell the stock at the strike price of the call option. The traditional approach to selling a covered call is to sell an out-of-the-money option that expires in about a month. The 1 month time frame is typical because it takes advantage of the high rate of time decay that short-term options experience relative to longer dated options. The reason you would normally do an out-of-the-money option is because you want to give the stock some room to increase in value, while hopefully not getting the stock called away from you. In the eventuality that the stock does get called away from you, at least it will have gone up in value if the call does get exercised. Well, let's look at an example. Suppose you own a stock that's trading for $50 per share. You want to do a covered call trade, and so you sell a 1 month 55 strike call on that stock. Remember, by selling the 55 strike call, you've agreed to sell the stock for $55 per share. In this example, you collect $1 in premium for selling that call. In an ideal scenario, the stock will go up over the next month, but stay below the sold call. If the stock goes to $54, you make $4 on the stock, the call expires worthless, and you get to keep the dollar premium you received for selling the call. Then you repeat the process the following month with a new call option. That's an ideal scenario. Since we know we don't live in an ideal world, we need to think about what is the worst thing that could happen to us in this type of trade. The worst possible outcome is if the stock crashes. Horrible news comes out, the stock drops to zero, and the company goes bankrupt. Yeah, we'd get to keep our premium we received for selling the call, but that's not much comfort when you just lost all that money on the stock. That is the worst case scenario. Another scenario that could occur is if the stock goes up faster than expected. In our example, what if the stock went up to $60 by expiration? Well, that's not necessarily a bad scenario. If that happens, you're going to end up selling your stock for $55, which is still a profit. You also get to keep the $1 premium received for selling the call. Now, you might be a little upset at missing out on some potentially larger profits from the stock, but you're still overall profitable in the trade. Let's look at a real-world example. Suppose you want to buy shares of this stock. Right now, that stock would cost $46.33 per share. Since you have to buy 100 shares, that would be $4,633. Let's sell a call at 48 strike that expires in 1 month. We're picking the 48 strike because it's out of the money, but it's close enough to where the stock is trading that you're likely to be able to collect a pretty decent premium for the option. The bid price for the 48 strike call is 59 cents. If we sell that call, we're getting a $59 return on our investment of $4,633. That's a monthly rate of 1.27%. As an annual rate, that's over 15% in income on a stock that you already own anyway. This doesn't include the potential for growth from the stock price itself. Now that we understand the possible scenarios of a covered call trade, let's discuss the risks and rewards of this particular example. The biggest risk is if the stock goes to zero. That's not likely, but we can't dismiss it completely, so we have to say the ultimate risk is the entire investment in the trade. Well, you could also get the stock taken away from you. As we already addressed, that's not necessarily a bad thing, but it could have potential tax consequences, and so you may want to monitor your position accordingly. Another often overlooked risk that a covered call has is that it does limit your short-term profit potential on a stock. The biggest reward from this trade comes from the long-term profit potential of the stock itself. We're also generating monthly income through the value of the call option. Let's go over some basic management rules for covered call trades. The stock part of this trade you manage just like any other long stock trade. Have a predetermined exit point for a loss. Techniques include things like having a set percentage loss, such as 10% or 8%. Could also be exiting based on support levels or using technical indicators or some fundamental metric. On the upside, you can hold on to the stock indefinitely or until you reach a certain profit target. Of course, you can always exit by getting called out of the trade as well. The option you sell in a covered call has two basic rules for management. First, you could just hold the option through expiration. Unlike many other option strategies, there's no real dollar risk from holding the call through expiration. The call will either expire worthless or you'll get called out. If you don't want to risk getting called out of your stock, you could create a rule that says to exit when most of the extrinsic value of the call has decayed. Covered calls are a way to create income, lower your cost basis in a stock position, and potentially reduce the overall volatility of your long-term portfolio.